This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in our previous session together, we saw how in opening years that in addition to the normal loss reliefs that would be available, the set-off against total income in the current tax year and the preceding tax year, the extension claims, the carry-forward claims against future trading profits there, that in addition to those normal reliefs, not in replacement of, but in addition to them, we could choose to go down the opening year's loss relief route. And the only way that got better than what was currently on offer was to allow the loss to be carried back a further period of time. And that gave us a 3-year carryback instead of the usually permitted only 1-year carryback. So when we come to cessation now, we're going to see another additional specialist loss relief. It goes by the name of terminal loss relief indeed here, and you see this in our final section, section 6 of this losses chapter. Now, before we move into that, you must again remember, what will we have anyway? Now, clearly what you won't have is a carry forward. The business has ceased to trade, so there's no possibility of carrying forward any trading loss. So that leaves you with your normal set-off against total income of the current tax year and or preceding tax year, with the usual then possibility of extension against capital gains in any such of those two, any one or both of those tax years indeed, for which you have firstly made the normal claim against total income and there is still loss left over. So how can we improve on that situation? Current year and carry back 1 year set off against total income and extension to capital gains. Well, yet again, as we've suggested a moment ago, the only way you can get better than that, given that there is no carry forward, is to allow a greater carry back. And again, we're going to see the ability that once we've computed, and there is now a very specific computation separate to our normal assessment work, which needs to be done, establishing the assessments, be they profits or be they nil assessments, establishing the loss that actually has arisen for any given tax year, to show the relief against total income for current and preceding year, to move to the extension claim. Terminal loss relief is a separate computation in its own right. But again, it won't be necessarily that instead of the other loss relief, though probably in an exam question and getting probably a Section A objective testing question, the chances are that it will be a very, very explicit question, I guess as they all must be, but to just compute the amount of terminal loss relief available. In a bigger written question in Section C, then you would have to discuss all of the available loss relieving options that exist for you. And as we've said, they are your normal, total income current preceding year, extension claim on either or both of those. What we then have, as I said, is this new terminal loss relief. Well, let's have a little look at what it does and how we compute it. We'll then do an example to show, first of all, the normal loss reliefs, and then very specifically, this new terminal loss relief. The terminal loss as computed is set against the trading profit. Now here we go, against the trading profit for the tax year of cessation. Now, this is just the way in which the rule is written. The chances are that if you are dealing with a terminal loss situation, that there is no trading income assessment other than nil for that final tax year, because you, of course, have a loss situation arising. But it would be set against the trading profit for the tax year of cessation, if any, and as we said, this is usually a nil assessment, given that there's a loss in the basis period that has arisen. But then against the trading profits of the previous 3 tax years, and this time, let's give it that one, on a LIFO basis. So again, what it's going to do, like we did in opening years, is if here though you can't go forward, but as an extra benefit will allow you to be able to carry the loss back further. But when that loss is carried back, it isn't against total income, as the way it is in the current year, the preceding tax year, the opening year's loss relief. All of those are set-offs against total income. Well, not this one. The terminal loss relief goes only against the trading income assessment. It goes against the preceding 3 tax years, and this time on a last in, first out, on a LIFO basis there. So we'll go with the most recent trading profit, assuming there isn't one for the final tax year. We'll go penultimate tax year first of all, then the one before that, and the one before that, extending against the preceding 3 tax years. Now, of course, anything that limits the loss relief at first sight sounds, well, if it's limiting, bad news. So you can only go against trading income. You can't go against non-trading income there. All your other, presumably, investment income. Actually, although, yes, that does limit it. And if it means we do not get to use all of our loss as a result of that, then that would indeed be bad news. But actually, this might work as a benefit to us, in as much as if we are now able to just take the top off our total income figures for the previous 3 years by removing just the trading income out of those previous 3 tax years, that may leave sufficient other income still in the computations of those years, which again doesn't sound like good news. But if those figures of other income are about the same level as the personal allowance for the tax year, then you won't pay any tax, or you'll pay very little tax anyway. So you then haven't wasted your terminal loss by setting it off against total income and eliminating all that income. You've only taken trading. Maybe you've left sufficient income to cover the available personal allowance, in which case you'll actually get a better use of the loss. Now, again, it's probably not for us to have to argue logically whether this is a good or a bad thing. It is what it is. So you have to remember we go against, once we've computed it, the trading income of, if there were any for the final tax year, there won't be. It will be a nil assessment for you. And then the trading income of the preceding 3 tax years, the most recent first, and working back in time over those 3 years, purely against trading income. So how do we compute the amount of terminal loss that is available for such relief? We want very specifically the loss of the final 12 months of trading. But that final 12 months of trading, given that it's unlikely that we cease trading on, say, the 5th of April, i.e. the end of the tax year, that last 12 months of trading is likely to span both what proves to be the final tax year and a part of the penultimate tax year. In which case, we need to compute this in 2 parts, dividing the last 12 months of trading between the final and penultimate tax years, and calculate as follows. Firstly, you will want the actual trade loss for the tax year of cessation, i.e. what loss was made from the 6th of April to the date of cessation, plus what will also go into this, something that we know arises or may arise in opening years, plus any overlap relief arising from opening years. Yes, that overlap relief doesn't just reduce profits. It will also be added in terms of any loss sustained in the final year to increase the amount of loss relief that is available. That will be true, as we'll see in a moment's time, as regards computing the actual loss for your normal, your usual loss relief claims. It is also true for terminal loss. So the last 12 months divided between how much falls into the final tax year, how much of it falls into the penultimate tax year. For the final tax year, what was the profit or loss? It's likely to be loss from the 6th of April through to the date of cessation. Add to that figure also the overlap relief from opening years. That's the first part of the terminal loss. The second part here is then any actual trade loss for the period 12 months before cessation until the end of the penultimate tax year. So we've gone from the 6th of April, the start of the final tax year, through to the date of cessation. that period is going to be less than 12 months. So we need to go back into the penultimate tax year and pick up the balance of what will be the last 12 months of trading. If we cease trading at the 31st of December, then we would have for the final tax year, 6th of April to the 31st of December. That would be allocated to the final tax year. But in this second part of the claim, what's in the penultimate tax year? Well, a date 12 months prior to the date of cessation of trading. If we cease trading at the 31st of December, that would be the 1st of January at the start of that year. So you would now want that 3 months worth of loss from the 1st of January to the end of the penultimate tax year. And in that way, you'll have covered the last 12 months of trading. But you must not do it in one single calculation. It must be done in two. What is in the final tax year, first of all? Add the overlap. What is then in the penultimate tax year? Take your time apportion figure of that. All right. If the result of either what you had in 1 or 2, i.e. what did you have as the actual loss of the final tax year, the part of the last 12 months falling in it, and what amount of the last 12 months loss in the penultimate tax year, if either of those should be a profit, now it's very unlikely that it would be that one. It is much more likely to be that one if it were to be tested at all. And to be honest, at Tax UK, basic tax paper, it's probably unlikely. But if either were to be a profit figure, then it would be treated as zero for purposes of the terminal loss computation. We don't put a profit figure into the terminal loss computation if it is the net result of either the first calculation or the second one. Any net profit overall for either of those two parts of the computation would be treated as nil within the terminal loss computation. Right, before you guys have a go at example 6, just prepared here a little example for us to have a go at. And what we're going to do is not just compute the terminal loss, though of course we will do it. What we'll also do is just work out, well, what are the normal loss reliefs that are available? Again, I've said already, a Section A objective testing question for 2 marks, it probably would be just compute the terminal loss relief available. If it's a part of a written Section C question, it's much more likely to ask you to identify what loss reliefs are available, the amounts of those losses that are available for relief under the different provisions, and also, of course, then to advise on which of the reliefs should be pursued with any reason as to why. Right, our example here, therefore. We're told, Donald ceased trading on the 1st of November 20. I hear hurrahs around the world. Donald ceased trading on the 1st of November 20, having previously made up accounts to, and here I really do mean made up accounts in the purest sense thereof, to the 31st of December in each year. So what we had was Donald was preparing accounts to December each year, and we have year ended December 18, year ended December 19, and we had profits. Also, he says, profits there. But then in that final period, again, hurrah, to the 1st of November 20, there we go, there's that trading loss. And what we've also got from opening years, as we've already spoken of, are the overlap profits of £10,000. Before we do the new bit, computing what is the terminal loss relief available and identifying what can be done with it, what I want you to do is to follow through on your normal closing year's bases of assessment, identifying what assessment will arise for each tax year. If in the basis period there is a loss, then the overall loss figure will be treated as a nil assessment. We never again are going to deal with negative assessments. If it's a loss in your basis period, that's going to be a nil assessment, and you'll separately then consider, so what can you do with that loss? Let's remind you about the process that you need to undertake here. And these irrespective of whether you're dealing with losses or whether you're dealing with profits. On a cessation of an unincorporated trade, as with opening years, the first thing you did was to identify the first tax year. Closing years, the first thing we do is to identify what is the final tax year, based, of course, on the cessation of trading date. Well, the 1st of November 20, well, that falls, of course, in the 2021 tax year. So you now know the final tax year is 2021. That is step 1. Identify final tax year based on date of cessation. Step 2, go back to penultimate tax year and assess using CYB. Go back to penultimate tax year and assess using CYB. Only when you have determined what is the final tax year, 2021, based on that date the business ceased trading, only having identified that the final tax year is 2021, can you then proceed to step 2 to identify the penultimate tax year. Penultimate tax year must therefore be the 1920 tax year. Well, we were preparing accounts to the year ends the 31st of December. So which of those two, using CYB, would have been assessed in the 2019-20 tax year, the 1920 tax year? Which 31st of December ends in the 1920 tax year? The 31st of December 19. So that is what would be assessed using CYB in 1920. There would be a profit figure of 18,000. If needed, therefore, the year ended December 18, that would have been assessed in 1890. So that would be CYB assessed, of course, as the basis of assessment, in 1890. So we'd use CYB all the way through to up to and including the penultimate tax year. So we know what will be assessed up to 1920. We know 2021 is the final tax year. So remember the steps. Step 1, what is the final tax year? Step 2, go back to penultimate tax year and assess using CYB. We've done that. And that seems to have disappeared. Why has that disappeared? I have no idea. Once we have dealt with step 2, then step 3, of course, is to go back to the final tax year and put in all remaining periods, whether that's a period of profit, a period of loss, whether it's a combination of the two, any remaining period. So anything post the year ended December 19 there is going to be put into, allocated to the final tax year. Well, there's only one period. That is that final trading period through to the 1st of November 20, where we have a loss of £30,000. Remember also, of course, we don't just pick up the adjusted profit for that period. That is going to, or adjusted loss, that is going to be further adjusted for the overlap profits. And an overlap profit doesn't just reduce what would have been a profit, it will also increase, as you have here, a loss. So can you please work out the assessments, therefore, for the relevant tax years, as far as that information provided will allow? I'll have to resurrect that particular figure, and I think if I look at my example there, that was £18,000. Hopefully that's the right number. Don't know why it disappeared. So could you work the assessments, please, for the final tax years? That's going to be 2021 back through 1920 and 1819. And can you then also establish in the process what is the actual loss that arises in relation to the final tax year? And as we discussed earlier, can you then identify where and how that loss could be used? What are your normal reliefs? I'm not talking about the new one, terminal loss. That's a separate computation. What would be able to be the use of that loss? So over to you. Pause now. When you've had your go at it, come back and I'll discuss through that and we'll see how we fared. Okay, to see how we've got on with this one. As we said, step 1, identify the final tax year based on date of cessation. That, as we've got up there, is 2021. So there's step 1, identify the final tax year. You don't do anything with it at this point, you just note it. Step 2, go back to penultimate tax year, well that must be the 1920 tax year, and assess using CYB. We had been preparing accounts to, or Donald had, the 31st of December, so that would have been the year ended 31st of December 19. That was a trading profit of £18,000 to be assessed. We've got information to go back one more year to 1819. Again, CYB assessment, year ended December 18, and that was the earliest profit figure we were given in this example anyway, £34,000. So we've dealt with step 2. Step 3, go back to final tax year and assess any and all remaining periods that have not yet already been assessed, and also include our overlap relief. So in 2021, having already come as far as the year ended December 19, there is only one more period to deal with, and it was that one there. Oh, God. Things disappear in front of my eyes here, yet again. That would have been the period through to, oh, no, it's come back again. That would have been that final period through to the 1st of November 20, and that was a loss figure here of, what was that loss figure? It was £30,000. There was no other period. Prior to that was the year ended December 19. We've already dealt with it. So that final period of trading had an adjusted trading loss of 30,000. But of course, what we must also do is to bring in our overlap profit, or overlap relief as we may call it. That would have reduced a profit. It therefore increases a loss and establishes a trading loss of £40,000. The assessment, of course, would therefore be nil. We know again, no negative assessments. The assessment is nil. And we've got a loss of £40,000 that has arisen for the final tax year. So then you'd identify, well, what can we do with that? So the current tax year is 2021. Therefore, set off against that £40,000 there, set off against the total income of that final tax year. Now again, in an exam question, you'd be told what other sources of income that the individual may have for that 2021 tax year as it is here. Set off against total income of that tax year. And or set off against the total income of the preceding tax year. Given that you've got a nil assessment for this, the final tax year, it is maybe more likely that if you're going to make any such claim against total income, it's probably more likely to be for the preceding tax year, because despite any other income you might have, you know that at least there is a profit back there. If you don't have very much in the way of other income other than trading, then there is your nil assessment for this particular year. If you don't have much, if any income, other income for that year, then you're going to have no tax to pay anyway, because any such remaining income, if it doesn't exceed 12,500 anyway, would be covered by the personal allowance. So if you're going to make such a claim, obviously the examiner can make up whatever numbers that he or she or they wish to, but it's probably going to be for 1920. If, of course, you make either of the claims against total income in the current tax year and or in the preceding tax year, for any such tax year that a claim against total income has taken place, and there is more loss than there is total income, then the remaining loss may be used against your capital gains, your net gains of that year. And again, there's a linkage there. If you've ceased trading, as Donald has done here in the 2021 tax year, if you've ceased trading, then it's perfectly possible that although the trading wasn't very good, that maybe there are business assets that are chargeable assets for capital gains purposes, like a property, for example. Donald was supposed to be quite good with property. So there might be a property there that may be sold, and that may give rise to a capital gain. So there's definite possibility of a link here in terms of a terminal loss situation. Again, not meaning the specific relief we're still to talk about, but in relation to a loss in that final tax year, if the cessation is as a result of disposal of that business, which is perfectly possible, then there may be capital gain. So it's one to consider for sure. There is no carry forward, of course, there because the trade has ceased. So other than those normal claims against total income, with possible extension claims against the net gains of the relevant tax year, that leaves us with one other possibility, and that is the terminal loss. Now, in terms of that terminal loss, remember, it's a separate computation and it comes in two parts as seen here. Firstly, we look at the final tax year and we want the actual trade loss for the tax year of cessation from the 6th of April through to the date of cessation, plus any overlap profits. So let's therefore do our computation of terminal loss. So we'd have a separate working for this, terminal loss computation, and we will look at, first of all, that part of the last 12 months of trading that falls into the final tax year. The final tax year, as we know, was 2021. The first part of it is any loss from the beginning of that tax year, 6th of April 20 there, through to the date of cessation, the 1st of November 20. That's the first bit. Again, it's going to require some apportionment exercise. Secondly, what we would add into it is any overlap relief. And that would give you the amount, first part of the computation of terminal loss, the amount of terminal loss that falls within the final tax year. But the terminal loss relief is available for the trading loss sustained in the last 12 months of trading. And as we've said, the last 12 months of trading is likely to span the final tax year and a part of the penultimate tax year. You now know that the penultimate tax year is 1920. There is only one thing to include here, and that is to pick up on any loss that goes back to a date 12 months prior to date of cessation, so the 1st of November 19, we ceased trading on the 1st of November 20, and that would take you through to, well, where did the final tax year start from? The 6th of April 20. So we'll go through to the 5th of April 20, therefore. Now what that will do is to include the last bit of the loss-making period and a little bit of the penultimate profit-making period. You put in your figure of loss, you put in your figure of profit, do the calculation. If that turns out to be a net loss, as I think it will here, then you add that into your terminal loss calculation. If it were to be a profit, you'd put nil into your terminal loss computation. So I'd like you, please, to do those calculations now for yourself. Work out what the amount of terminal loss relief would be, and to state what then could be done with it. What will it be set off against, as far as the information provided here will allow. So pause at this point, you have a go at that, get the amount of terminal loss, state what can be done with it, and then come back and I'll talk you through it. Okay, let's see what we made of that, therefore, and what terminal loss, if any, that we have computed. First of all, the final tax year. That's from the beginning of that tax year, the 6th of April 20 as it was here, through to the date of cessation, the 1st of November 20. Now, all of that falls within that final 10-month accounting period that went through to the 1st of November. 7 of those 10 months fall within that final tax year. So we're taking here 7/10 of the loss of 30, and that therefore should equal, as you can see there, £21,000. We also pick up and allocate to this final tax year all here of that overlap relief. So we've got a total so far, a subtotal here, of 31,000 within the terminal loss relief claim. And having dealt with how much of the last 12 months of trading falls into the final tax year, we now ask the question, well, how much also fell into the penultimate tax year? So the penultimate tax year, the 1920 tax year, we said, as we noted there, we go back to a date 12 months prior to date of cessation and come through to the end of that penultimate tax year. That is a period of 5 months, so working back in time, we're taking 7 of the final 10-month loss-making period and allocated to the final year. That means that some 3 months of that period, so 3/10 of 30,000, is allocated to this part of the terminal loss computation, the bit falling in the penultimate tax year. But the remaining 2 months were 2 months out of a 12-month period in which we made a profit of £18,000. That therefore would be 3,000, as we can see there. So we've got loss 9, profit 3, net the 2 out, £6,000. Add that to the 31,000 up there, and we're looking overall, therefore, at a terminal loss relief being available amounting to £37,000. Now, before I take this any further, just be careful about one of the notes that is perfectly correct, but it may be misinterpreted. It says here, this last bit, that when we did that calculation, if the result of either the first or second calculation, the bit of the loss in the final tax year, the bit of the loss in the penultimate tax year, if the result of that had been a profit, then it would be treated as 0 for purposes of the terminal loss computation. Please therefore understand that what we have done here, in case you had any doubt, we took within that 5 months of the penultimate tax year that fell into the last 12 months of trading, we took the 3/10, the remaining 3 months of the loss-making period, and then 2/12, 2 months worth of what is a profit period. We net those two out. We do not treat there that £3,000 as nil. We net them out, it comes to £6,000. If that net figure there had instead been a profit, that is what would have been treated as nil. Now I stress this because always this gives rise to problems for students. So understand, we need that figure of loss, that figure of profit. If, as here, the profit of 3,000 is less than the loss of 9, it gives you a net loss that is added in to the terminal loss. We do not treat the 3,000 as nil. But if that, instead of being 3,000, had been £30,000, that would have meant 30,000 profit, 9,000 loss, net profit 21,000. You wouldn't in there have put a profit of 21. You'd have put nil in there. So you individually calculate loss, individually calculate profit, net them out. Only if that net outcome had been a profit would you treat it as nil for purposes of this terminal loss computation. That did not happen, therefore the terminal loss is £37,000. What can we do with that terminal loss? It was very simple. The terminal loss we set against the trading profits of the previous 3 tax years on a LIFO basis. So the previous 3 tax years, and we could again set this up in columnar form, going back to the question. Oh, those figures disappeared, didn't they? But we had the previous numbers were, we had year ended December 19. That was a profit of £18,000. And we had year ended December 18. That was, how much was that? That was 34,000. 34,000. So your terminal loss relief would firstly go, it goes on a LIFO basis. This is what would be assessed in 1920. That is what would go in 1819. We agreed those assessments earlier. Terminal loss relief would be 18, bringing that down to 0. Of course, for the tax year 1920, we might have had other sources of income, and that therefore would still go into the income tax computation. The terminal loss relief only goes against the trading profit. That's used 18 out of that 37. That would leave what, 19,000, terminal loss relief, 19,000, to go against the trading income assessment in 1819. So we could have gone back one more year, 1920, 1819, 1718. It's a 3-year possible carry back on a LIFO basis, but we've used up all of that £37,000 worth of terminal loss against the penultimate, the 1 year back and then 2-year carry back. That would have left somewhat 15,000 still to be assessed in the 1819 tax year. If all you get is Section A objective testing question, compute the amount of terminal loss, the only working you need to do, you don't need any of the assessments, you simply need this working here. What was the final tax year? What amount of loss arose within that final tax year from 6th of April to date of cessation, and include the overlap relief. Into the penultimate tax year, how much of the last 12 months of trading fell in that year, and what amount of loss still needs to be allocated to it. And if you, as is then likely, you go back to the penultimate accounting period, if that was a figure of profit, what figure of profit is that? Net them out. The remaining net loss, add it to terminal loss. If the result of that netting process, bit of loss, bit of profit, the net result was a profit, then nil would go to the terminal loss computation. If, on the other hand, it was a Section C written question, where we would have to do all that we have done here in terms of advising what all the different loss relief options would be. And for that, therefore, I would always have started by dealing with it just like any other closing years problem, working my assessments for those final tax years, and we would discover that here, as it was in 2021, there was a loss of 40,000, and that gave you a nil assessment. Work out what the assessments are, work out the actual loss sustained in the final tax year. What could be done with that £40,000? I can hear some of you think, hang on a minute, the terminal loss was only 37. What could you do with that actual loss of 40,000? We've already said total income of current tax year and or preceding tax year, and for any of those years in which we've made such a claim and there's loss left over, the extension claim against capital gains. The separate computation was of terminal loss. That came to 37,000. How and where would it be used? We've identified that loss of 37,000 going back on a LIFO basis. 2021 was the final tax year. There was no trading income assessment for that year. The basis period was a nil assessment. So it goes to 1920 and then back, as you can see there, to some at least of 1819. It could have gone as far back as 1718. Only against trading income. You would be using the same criteria as we've used all the way through in judging which of those reliefs is going to be most beneficial. We want to get relief at the earliest available opportunity. Well, all of these will involve probable carrybacks, so they'll all generate repayments. The current and preceding year claims target total income. The terminal loss relief claim targets only trading income. Now, if, as here, there is enough trading income in the preceding 3 years to absorb that loss, then that is likely to be much better than the claim against total income, because a claim against total income runs that risk of wasting the personal allowance. With the relief here only going against trading income, it leaves untouched any other non-trading income still to absorb the personal allowance. So we don't pay any tax on it anyway, and there's more loss to go back against more trading income. And again generate repayments. And if, of course, going back, you're able to get back to a year in which you were a higher rate taxpayer, then you're going to get relief at the higher rate. Relief, earliest available opportunity. These are carrybacks. They'll give that. There is no carry forward. Gaining relief at the highest tax rates, and of course, as we've said, at the earliest available opportunity. And the point there, avoid wasting the personal allowance. It's possible we may still do that, but if there is other income, then the terminal loss claim at least only targets trading income, leaves the other income, less chance of wasting the personal allowance. What you will have picked up on there is that this terminal loss is only 37. So if you were doing a Section C question and you had to identify all of the loss reliefs available, you would say, having dealt with that terminal loss in the way that we have there, you would then say that because there was an actual loss of 40,000, of which only 37,000 was available for terminal loss relief, the remaining £3,000 would be available to set off against the total income of current tax year and or preceding tax year. That would still be available as part of the actual loss. That 40 compared to 37, that extra 3,000 unused, that could still be used against total income. Now again, if of course the total income figures that still remain are themselves less than the personal allowance, it'll do you no good anyway. But we should state, in this example with these numbers, post-terminal loss relief claim, there's still 3,000 loss that can be claimed against total income of either the current tax year or the preceding tax year. Okay, that said, time for you therefore to do more work. We have this final example 6 here for you to have a go at. And all you've got to do here, show the loss available for relief under terminal loss relief, assuming overlap profits on commencement were 5,000, and state how this loss would then be relieved. Okay, over to you therefore. I'll leave that one to you and for you to review through that before we begin our next session together, which, given that we've just completed Chapter 7, will move us to Chapter 8. And what that brings in is how to deal with partnerships. We've spoken about the unincorporated trader, but an unincorporated trade could either be, as we've seen it so far, in Chapter 4, Chapter 5, Chapter 6, and now losses in Chapter 7. Could be a sole trader, that's what we've seen. But an unincorporated trade would also mean we're dealing with partnerships. And with partnerships, there's no longer a tax-adjusted trading profit or loss that belongs to one person, the sole trader. So what we have is one extra exercise over and above what we've seen so far. In Chapter 4, we dealt with adjustment of profits. If we're dealing with a partnership, you still have to adjust up the statement of profit or loss of the partnership. We still have to compute and deduct the capital allowances for the partnership, for the assets that were bought or that we held at the beginning of the period. We do our normal capital allowances computation. And that gives you, let's assume to begin with, a tax-adjusted trading profit. And that then is where a very simple new bit of work comes into play. That profit, or indeed potentially, given what we've just looked at in this chapter, that tax-adjusted trading loss doesn't belong to one person, it belongs to two or more partners. So what have we got to do with it? We have to divide that profit or loss between the partners. How do we do that? Using the profit sharing agreement. The partnership agreement will have written into it a profit sharing agreement as to how those profits or those losses will be divided between the partners. You've done that already in your accounting studies. You know that a profit sharing agreement may call for the payment of a so-called salary. In tax terms, that is not salary, that is not employment income. It's just which partners are getting the first share of any available profit. It is merely a way of dividing out the profit. So it could be called salary. For partners who do less work but put more money in, there may be interest on capital. This is not interest income, this is simply who again gets the next share of any available profit. And finally, though in many questions this will be the only bit of the partnership, the profit sharing agreement, there's a profit sharing ratio, how that balance of remaining profit will be split between the partners in their PSR, their profit sharing ratio. So it's a very mechanical exercise. It's very numerate based, and okay, it could be section C, but it probably lends itself again rather more to an individual section A question. But we'll be dealing with that next time. Prior to that, make sure again you are comfortable with all that we've done so far.